The presentation is on liquidity risk in SBI. Group members are Vipul Venu and Vishnu Priya. Liquidity risk. Liquidity risk is the risk that a given security or asset cannot be traded quickly enough in the market to prevent a loss. Important objective of the bank's liquidity management is to maintain an optimal asset to liability maturity portfolio that minimizes liquidity risk while maximizing profit. Types and measures of liquidity risk. Types: funding liquidity and market liquidity. Funding liquidity. Risk that liabilities cannot be met when they fall due, can only be met at an economic price, can be name specific or systematic. Market liquidity. An asset cannot be sold due to lack of liquidity in the market, essentially a subset of market risk. This can be accounted for by widening bid-offer spread, making explicit liquidity reserves. Bid-offer spread. The bid-offer spread is used by market participants as an asset liquidity measure. To compare different products, the ratio of the spread to the product's mid-price can be used. The smaller the ratio, the more liquid the asset is. Market depth. Market depth is the amount of an asset that can be bought and sold at various bid-ask spreads. Immediacy. Immediacy refers to the time needed to successfully trade a certain amount of an asset at a prescribed cost. Resilience. Resilience is the speed with which prices return to former levels after a large transaction.
Moving on to SBI liquidity policy. SBI monitors its liquidity position through a structural liquidity gap analysis carried out fortnightly in accordance with RBI guidelines on asset liability management. The bank has an extensive branch network and therefore holds deposits from large number of retail customers. These deposits provide a stable resource base for the bank. Risk Management Committee of the Board oversees the policy and strategy for integrated risk management relating to various risk exposures of bank, including credit, market liquidity and operational risk. The bank also has an asset liability management policy which prescribes various prudential limits for liquidity risk and interest rate risk management. ALCO has the job of managing liquidity and interest rate. ALCO manages and controls the structure of asset liability and interest rate sensitivity with a view to maximizing profit. SBI also uses Oracle Financial Service application which further help them to maintain the liquidity levels. SBI maintains asset liability structure such that negative liquidity gap in period of 1 to 14 days and 15 to 28 days does not exceed 20% of cash outflow in the same period. The net cumulative negative mismatches during the next day 2 to 7 days, that is, and 8 to 14 days and 15 to 28 days should not exceed 5%, 10%, 15% and 20% respectively of the cumulative cash outflow in the same. The bank undertakes dynamic liquidity management and prepares the statement of structural liquidity, and the statement is reported to RBI on a timely basis. Thank you.